Hello, Chartered. Good noon, everybody. We are here for the CA Foundation revision sessions as organized by JK Shah sir and JK Shah classes. In the foundation, we have finished all the chapters barring two, that is partnership and company. Today, we'll start with partnership, and partnership is a chapter which most of you are comfortable because you have done it in your +2 standard also, that is 11th and 12th, the first PUC, second PUC, whatever you call it. So without wasting much of your time, let's directly enter the important aspects of partnership, that is valuation of goodwill, treatment of goodwill, JLP, and the streak of 6-7 questions which gives you a hang of it. So let's start with partnership chapter. Now, partnership. Valuation of goodwill. Goodwill means chartered future profits. When an organization is selling itself, the other organization is buying, the buying organization has to pay the selling organization for future profits. The payment for future profits, suppose the estimated future profits are 30,000. And the selling organization says, I want future 5 years ka profit. That means buying organization is purchasing future 5 years profit, and that's why we multiply profits into years of purchase. That means buying organization, that means chartered buying organization. 1 minute. Sorry for the technical issue. Now, let's restart. What is goodwill? Goodwill is future profits. When one organization buys another organization, when one organization chartered buys another organization, the selling organization has been doing business from past n number of years and they have put in a lot of hard work to generate profits. So the selling organization says that because of our past efforts, future profits will come into play by default. Because of our past efforts, future profits will come into play or will come into the organization by default. So selling organization says, if you want to purchase me, you are supposed to pay me 5 years of future profits. And the buying organization purchases 5 years of future profits. Suppose estimated future profits comes to 30,000 and the buying organization has to pay 30,000 into 5, that is 1,50,000 to the selling organization. This 1,50,000 chartered is nothing but goodwill. That means buying organization is purchasing future profit of 5 years, which were or which would be earned because of efforts given by selling organization. Am I clear, chartered? So what is goodwill? Goodwill is nothing but future profits. Now, future profits are estimated. How do we estimate? Based on our past performance, we calculate future profits. Am I clear? That future profits we call over here as average profits. So first, let us learn how to calculate step 1, calculation of average profit. Profit we generally say it by pi. Calculation of average profit. Now, how to calculate average profit? This average profit represents future profits. How do we calculate future profits? We calculate future profits based on our past profits. Suppose the first we take total book profit of past n years as decided by the organization. Can be n, can be 3 years, 5 years, 7 years, as many. So total book profit of past n years. This book profit is as per profit and loss account. Every year the profit sometimes contains non-recurring income and non-recurring expenses. Such non-recurring income and expenses should be removed because they would not be incurred in future. From past profit, suppose last year I earned a profit of 20,000. Last year I earned a profit of 20,000. So I am expecting that next year same profit I'll earn. So next year also I am assuming I'll earn 20,000. But then I realized that out of this 20,000 chartered, 2,000 is profit on sale of plant and machinery. I realized that out of this 20,000, 2,000 is profit on sale of plant and machinery. That means my actual business profit was 20,000 minus 2,000, that is 18,000. So I say 18,000 is my expected future profits. In the current year, I earned a profit of 20,000, but that includes a non-recurring profit of 2,000, which I would not earn in the future because that is not a business profit, that is not a business income, and that is a non-recurring nature. So from past profits, we eliminate the impact of non-recurring and non-operating items. Non-operating means non-business items. If you remove non-operating expenses, if you remove expenses, expense would decrease and profit would increase. So add Loss on sale of fixed assets or investments, non-recurring, less profit on sale of fixed assets or investments had abnormal loss, that is goods destroyed by fire, add voluntary retirement compensation, voluntary retirement compensation, less insurance claim received. All these are charted non-recurring and non-operating income which I would have earned in some years. Suppose there are year 1, year 2, year 3, year 4. Did I are this profit or loss on sale of fixed assets, insurance claim received, abnormal loss, voluntary retirement? Did it happen every year? No. 1 year mein profit happened, 1 year mein loss happened, 1 year mein voluntary retirement happened, 1 year mein insurance claim was received. So instead of removing from individual years and then adding up, first I am adding up and then I am removing. It means one and the same. Either you remove it from the individual years and then add, or you add first all the profits and then remove it from the total profit. It would mean one and the same. This would give me total profit of n years. Now, average profit of n years is equal to, suppose this is A, then it would be A divided by n years. That would give me average profit. That means on an average I have earned in past every year so much, less interest income. Why? Interest income per annum. Why? Because this is not my business income. Again, I could have subtracted total interest income from total profits. I could have subtracted total interest income from total profits, or yearly interest income from average profits. Suppose 4 years ka profit is there. Every year interest income is 1,000. So I could have done, I repeat, suppose 4 years ka profit is given. Profit for 4 years is given. Interest income is 1,000 per annum. So in 4 years, how much I have earned? 4,000. Either I could have subtracted 4,000 from the total profit, or I can subtract 1,000 from the average profit. It means one and the same. Correct, charter? Yes, sir. Less fair remuneration to partners. Because whatever remuneration partners were getting, or whatever remuneration generally partners should get as working people, that remuneration should be subtracted, because the buying organization has to pay either those partners if they become employees, or if they appoint other employees, they have to pay that remuneration. Are you understanding? If Mr. A, B, C are running the business and I purchase their business, so who will run the business? Either A, B, C will run the business as employees now and I have to pay them remuneration, or I have to appoint somebody in place of A, B, C to run the business and I have to pay him fair remuneration. Although I am the owner, I will still remain the owner. But whatever working ABC were doing, either ABC will continue to do their working as employees now instead of partners, and I have to pay them remuneration, or I have to appoint some employee to whom I am supposed to pay that fair remuneration. Else, I have to pay myself that remuneration. Ultimately, that remuneration will be paid less. Remuneration from alternative employment. Correct? Sir, what is remuneration from alternative employment? Listen to this carefully. Suppose teaching this batch, income generated is 100 rupees. Teaching this batch, income generated is 100 rupees. 20 rupees is paid to the payser. So JK sir's profit is how much? 80 rupees. 20 rupees income, 100 rupees income, 20 rupees payment to the payser. So 80 rupees is the sir's income. Yes. Now, chartered, if sir would have himself taught, then what would have been his profit? If I would have taught, then the profit going to sir would have been 80 only, because 100 rupees income and 20 rupees payment to teacher. Yes, sir. But if he himself was teaching, you would start thinking 100 rupees profit. You are correct. 100 rupees will go into his pocket, but not as profit. Then he would say, that if sir was teaching somewhere else, he would have earned a teaching income of 30. Yes. If sir would have not taught this batch and he would have taught somewhere else, he would have earned 30. Correct. So from this income of 100 rupees, 30 rupees is his teaching income. So business profit is only 70 rupees. If he would have taught elsewhere also, he would have earned how much? 30. So what he is earning extra? 70 rupees. That is profit of the business. And that is why we subtract remuneration from alternative employment. Now, if this business is purchased by somebody, that somebody has to pay, will consider profit as 100 or profit as 70. The person who is purchasing business will consider profit as 100 or profit as 70. He will consider profit as 70, because he will also say 100 rupees is income from the batch and 30 rupees is payment to teacher. Fair enough? Yes, sir. That means payment to teacher has to be subtracted. Suppose the owner of the class generates an income of 100. He himself is teaching. What he would say, if I was teaching somewhere else, I would have earned 30. So 30 is my teaching income and 70 rupees is profit. If somebody buys this business, then he would say 100 rupees is income and 30 rupees would be payment to teacher, whether the old teacher or a new teacher. So ultimately profit would be 70. Correct? Yes, sir. This gives us chartered average profit. Some people call this as future maintainable profit. Is that correct? Absolutely correct. This is future profit only. But I am using the word average profit because our institute uses the word average profit. But this is average future profit which the buying organization is buying. Achha. Step 2. Calculation of super profits. A, capital employed. Capital employed. Capital employed is nothing but assets minus liability, or capital plus reserves and surplus. Asset minus liability or capital plus reserves and surplus. Whenever you say capital, it by default implies capital plus reserves and surplus. Now charter. B. Normal rate of, rather, rate of return. If you have invested capital in the business, what is the return we are expecting? Rate of return percentage. That is normal rate of return plus rate of risk. Normal rate of return plus rate of risk. Because of risk, we are earning extra. So rate of return is normal rate of return plus rate of risk. If rate of risk is not given in the question, no problem. So suppose X%. Normal profit is equal to capital employed into rate of return percentage. D. Average profit from step 1. Super profits is equal to average profit. That means the profit which I am earning minus normal profit which anybody would have earned. The extra profit which we are earning is super profits. Correct? Yes. This was step 2. Now charter. Step 3. Is valuation of goodwill. Valuation of goodwill chartered. Method 1. Average profit method. Under average profit method, goodwill is equal to average profit into years of purchase. YOP is years of purchase. Method 2. Super profit method. Under super profit method chartered, goodwill is equal to super profit into years of purchase. Super profit into years of purchase. Method 3. Annuity method. Annuity method में chartered goodwill is equal to super profit multiplied by annuity factor. Method 4. Capitalization method, where goodwill is equal to average profit divided by rate of return percentage minus CE. CE means capital employed. Or we can say goodwill is equal to super profits by rate of return percentage. It means one and the same. Why there are 4 methods? How to decide on which method? Chartered, all this was explained in the regular batches, but this is not required from exam perspective. And moreover, these methods have now become obsolete in the real world. Now, Goodwill is not valued on the basis of profit, but it is valued on the basis of revenue. So all this method, once upon a time, had a beautiful logic. Why there are 4 methods? Which industry, which methods are applicable? How these methods were derived? How time value or money was applicable? Everything was there. But now, not required. And plus, this is a revision batch where examination are more important. Now, Chartered, if you look at capitalization method, I told goodwill is equal to average profit by rate of return minus capital employed. Now, if you take LCM, it will become average profit minus ROR percentage into CE is equal to average profit minus normal profit. ROR percentage. Average profit minus normal profit is super profits by ROR percentage, and that is the second formula. So the first formula is known as capitalization of average profit. Last formula is capitalization of super profits. And chartered, both the formulas are same. So answer will also be same. Correct? Yes. So this is your valuation of goodwill over. Now chartered, let's go to treatment of goodwill. Of goodwill. Now chartered, as per accounting standard 26, only purchased goodwill can appear in balance sheet. Self-generated goodwill, only purchased goodwill can appear in balance sheet. Self-generated goodwill, out of our efforts, cannot appear in balance sheet. Why, sir? Because self-generated goodwill may we did not incur any cost. Oh, so it does not satisfy money measurement concept. Oh, so self-generated goodwill does not appear in balance sheet. And in partnership, we always assume that the partnership has started as retirement, admission, death. But at this level, there is no concept of one partnership business purchasing another partnership business, and the buying partnership business has purchased the goodwill, and hence goodwill appears in the balance sheet. In foundation level, we assume there is no purchase of businesses. So whatever goodwill is there is always self-generated in partnership. So instead of, I spoke so many lines, which were the most important lines are only purchase goodwill can appear in balance sheet, self-generated goodwill cannot appear in balance sheet since it does not have cost. In partnership in foundation level, we assume that goodwill is always self-generated. Am I clear? If goodwill is always self-generated chartered, will it appear in balance sheet? No. So step one. If there is book value of goodwill appearing in balance sheet, then it should be written off among old partners in old PSR. Old profit sharing ratio. But this would happen only if there is book value of goodwill. If there is book value of goodwill, it should be written off. Why goodwill cannot appear in balance sheet? That means if there is goodwill in the balance sheet, it should be written off. It should be written off. That means it should be removed. If you remove goodwill from the balance sheet, goodwill will decrease. Goodwill decrease, you are happy or sad? Sad. Sad means profit or loss? Loss. So if asset decreases, there is a loss. If there is a loss, capital will go up or come down. So capital will come down. Therefore, capital will be debited. The journal entry will become old partners capital account debit to goodwill. Narration will be being goodwill written off. This is an old PSR and this is book value of goodwill. That means value of goodwill appearing in balance sheet. Now chapter. Step 2. Table entry. Goodwill का treatment is what? Gaining partner will sacrifice. Gaining partner will compensate sacrificing partner. Gaining partner will compensate sacrificing partners. How to calculate that? Suppose started, there are 4 partners A, B, C, D. This is a retiring partner. This is new partner. Correct. Suppose goodwill valued at in old profit sharing ratio. That is adjustment wala goodwill. Balance sheet wala goodwill you have removed it. Goodwill valued at in old BSR. D is not there. Goodwill valued at in new profit sharing ratio. In new profit sharing ratio, we will not get one minute chapter. B will not get, C will get, D will get. Now charted, then you find the net impact. He is sacrificing and this person is gaining, that is for sure. Because D did not have any share in old goodwill. D did not have any share in the old goodwill, but he has share in the new goodwill. So old share nothing, new share so much. So gain. B had old share so much, new share nothing. Therefore, he is sacrificing. A, if new share is more, gain. If new share is less, sacrifice. Achha, they are supposed to find gain or sacrifice. If new share is more, it is gain. If new share is less, it is sacrifice. And then we would pass the journal entry. Gaining partners, capital account debit, to sacrificing partners capital account. Being goodwill treated. Now charted, this is known as new partners share of goodwill or premium for goodwill. New partners share of goodwill or premium for goodwill. Premium for goodwill is a short form is PFG. This step 2 you are supposed to do in all questions. Step 3. If if new partner brings his share of goodwill in cash. If new partner brings his share of goodwill in cash chartered, then the journal entries cash or bank account debit to new partner's capital account and chartered, the amount will be premium for goodwill plus capital which he is bringing. But this is again if new partner brings, then you are supposed to pass this entry, otherwise not. So first step is also if. Second step always. Third step if. Step 4. If old partners withdraw their share of goodwill in cash, then the journal entry will be old partners capital account debit to cash bank. Correct? Now this is also if. So step 1, 3 and 4 are if. Step 2 is always the treatment of goodwill. Achha. And step 3 and 4 would come only if there is admission of a partner. This was the treatment of goodwill. Hidden goodwill. A's capital 40,000, B's capital 30,000, C comes for 1/4 share and brings rupees 30,000 as capital. Calculate goodwill on the basis of capital. Calculate goodwill on the basis of capital. Now charted C is a share is how much? 1/4. And for 1/4 his capital is how much? 30,000. Therefore, A plus B's capital should be for 3/4 how much? 3 into 30,000, that is, should be 90,000. But A plus B's capital is how much? 40 plus 30? 70, 40 plus 30 is given in the question. Therefore, 20,000 the capital which you cannot see. That 20,000 intangible capital is nothing but goodwill. Achha. C's share is 1/4, 30,000, therefore 3/4, 3 into 30, 90. So where is 4? 4 will get cancelled. Achha. Concept. Four. Treatment of JLP. Treatment of JLP. Of JLP. What is so special about JLP? There is nothing special about JLP. Yeah, but there is a difference between plant and machinery is also an asset. Furniture is also an asset. So why so special about JLP? Joint life policy. The speciality about JLP is that it is the only asset of the firm which is in the name of the partners. Rest, all assets of the firm are in the name of the firm. Plant and machinery, land and building, furniture, fixture, vehicle, everything. It is the asset of the firm in the name of the firm. But JLP is the only asset of the firm which is in the name of partners. So, does it mean it is partners' asset? No. It is firm's asset, and on that asset, everybody has a right. Achha. JLP. If surrendered, if JLP is surrendered chartered, then what shall be the journal entry? Bank account debit, MR. MR means money received. Bank account debit MR to JLP account book value difference is equal to revaluation. Achha. Bank account debit MR to JLP book value to revaluation. That means there's an asset in the balance sheet which is sold. Surrendered means sold. You get the money back. Correct. If the money is more than the book value, it's a gain. If the money is less than the book value, it's a loss. Gain and loss is transferred to revaluation. Instead of transferring it to revaluation, you can directly transfer to old partner's capital account also. But no. Achha. No. MR is equal to money received in case of retirement, it is surrender value, In case of death, it is policy value. Policy value is also known as surrender value. Now, JLP will always have a book value, maybe, may not be. If book value is there, then you write the book value. If book value is not there, then instead of, then over here you write 0. If you write 0 over here, entire money received will be transferred where? Revaluation. Oh, so if book value is not there, this will become 0. And entire book value, entire money received will be transferred to revaluation. Yes. So do we need to write to JLP 0? No. Then you can write bank to revaluation. If there is book value, write the value of book value and transfer the difference to revaluation. If there is no book value, this will become 0 and hence everything will be transferred to book value. Everything will be transferred to revaluation. And that you would have studied that if there is book value, it is treated as an asset. If there is no book value, it is treated as a expense. If not surrendered, if JLP is not surrendered, and the question is of admission, retirement, or death, then revalue JLP through revaluation account and show it in balance sheet. So the entry will become JLP to revaluation or revaluation. Like suppose, understand this C3 situation. This is balance sheet. There is JLP appearing at 10,000. Adjustment mein it is given JLP surrender value 12. Adjustment mein it is given JLP surrender value 12. So you will increase JLP by 2,000 and show 2,000 profit and revaluation like other assets only. If JLP's surrender value is 8, that means you will decrease by 2,000 and show that 2,000 in revaluation, normal like other assets only. Achha. Sir, can value of JLP decrease? No, it cannot. But if in the question it is given, don't argue. Suppose balance sheet mein there is no JLP. And adjustment mein it is given, surrender value of JLP is 10,000. Then write JLP to revaluation 10,000 and show JLP in balance sheet. That means it is like any other assets, just revalue JLP through revaluation. You can use capital account also, but revaluation is an easier option. Okay. But charted if the question is of change in PSR. Then first, JLP account debit to old partners capital account in old profit sharing ratio. Is increase the value of JLP. Second, old partners capital account debit to JLP in new profit sharing ratio. Partners will be old only. Why? Because there is. Why? Because it is change in profit sharing ratio. There is no admission come return. That means you can first you need to raise JLP and then write off JLP. So like treatment of goodwill, they will get their share of JLP. Gaining partner will compensate sacrificing partner. Sir, instead of passing these two entries, can we pass the stable entry in case of change in PSR? Yes. Correct chartered? Yes. So this is how it works. Now chartered. Let's solve few questions. This is very, very important. This you would not have done it earlier. Change in PSR. Anyway, let's go to now. In partnership, chartered valuation of goodwill. Please write down. Note. If question specifies to use average capital employed instead of capital employed then use average capital employed. Correct? If the question says use average capital employed, use average capital employed. Average capital employed is equal to opening capital plus closing capital divided by 2. Starting of the year, ending of the year divided by 2. Opening capital plus closing capital divided by 2 is equal to average capital. Now, question number 20. Vasudevan, Sundarajan and Agarwal are in partnership sharing profits and losses in the ratio of 2:5:3. The balance sheet of the partnership on 31st of March 2017, that is year end, was 85, 315 and 250. They earned a profit of 2 lakh in 2017 and withdrew rupees 1,50,000 during the year. Normal rate of return is 30%. They are required to calculate value of goodwill on the basis of 5 years purchase of super profits. For this purpose, calculate super profit on average capital. Now charted average capital is opening capital plus closing capital divided by 2. And this, the balance sheet is on the year end. So charted This is closing capital. Why? Because this is on year end. Achha. So to first find out average capital, we need to first find out opening capital. Then we need to find out average capital. Then we can do calculation of goodwill. Okay. This is year-end balance sheet, so this is closing capital. Correct. Now let's start. Solution to question 20. Calculation of opening capital employed. Now charted opening capital employed plus net profit minus drawings is equal to closing capital employed. Opening capital employed, I don't know. But net profit is 2 lakh and drawings is 1,50,000 and closing capital employed is equal to 85,000 plus balance sheet is given 3,15,000 plus Agarwal 2,25,000 or opening plus 50,000 is equal to 6,25,000. Therefore, opening capital employed is equal to 625 minus 575. Correct? Yes. Thereafter, charted calculation of average capital employed. Average capital employed is equal to opening capital employed plus closing capital employed. Opening capital employed we calculated just now as how much? Closing capital employed we have calculated as over here 625. This is closing capital. Can you see? Yes. Plus 6 lakhs. Is equal to. So closing average capital employed. Now charter. Step 1 to calculate goodwill. First we need to calculate average capital, average profit that is given. So calculation of goodwill. Calculation of goodwill. Average profit. In this question it is given. How much? 2 lakh. B, average capital employed 6 lakhs. Normal rate of return percentage 30%. Therefore, normal profit is equal to 6 lakhs into percent, that comes to 1 lakh 80. Therefore, super profits is equal to 2 lakh minus 1 lakh 80 is equal to 20,000. Correct? Yes. Years of purchase is equal to 5 years. Therefore, goodwill is equal to 20,000 into 5 years is equal to rupees 1 lakh. Correct? So over here you had to calculate average capital. Now some people look at this table and say, hey, he did not do anything like this because these informations are not given. They have directly given us average profit. Okay. If they had given the information, I would have done it. So this is a question number 20. Now, question number 21. J and K are partners in the firm. Their capitals are 3 lakh and 2 lakh. Therefore, total capital employed. Therefore, is equal to 3 lakh, 5 lakh. During the year ended, the firm earned a profit of 1 lakh 50. So again, see, average profit is directly given to us. Average profit. Assuming normal rate of return is 20%. Calculate the value of goodwill of the firm by capitalization method. By super profit method, if goodwill is valued at 2 years purchase of super profit. How many years purchase? 2 years purchase of super profits. चलिए. $222. Correct? Yes. So over here directly, first calculation of super profits. Capital employed $2 lakh is equal to 5 lakh. Rate of return is equal to 20%. So normal profit is equal to 5 lakhs into 20%, 1 lakh. Average profit is equal to 1,50,000. Therefore, super profit is equal to average profit minus normal profit. It is 50,000 simple. Now charted, they have asked us to calculate goodwill under capitalization method. So for goodwill under capitalization method is equal to super profits by rate of return percentage. Super profit is how much? Rate of return percentage is just 2,50,000. Goodwill under super profit method. Goodwill is equal to super profit into years of purchase. Super profit is 50,000 and chartered years of purchase is 2 years given in the question. Therefore, goodwill is equal to 1. So that means under different methods, the value of goodwill will be different. Yes. Simple only. So average profit they have already given. No, yes. Now charter. Question number 22. The profit and loss for the previous year's profit 2015 profit 10,000, 2016 loss 17, 2017 profit 50, 2018 profit 75. That is 4 years. The average capital employed. So capital employed is given. The rate of interest expected from investment is 10%. The remuneration from alternative employment of the proprietor is. Calculate the value of goodwill on the basis of 2 years purchase of average of 3 years. That means you are supposed to take 3 years only. Which year you will not take? The first year you will not take. So you will take a loss of 17, profit of 15 and profit of 75. 3 years, average profit of 3 years. Okay. Solution to question 22. Calculation of average profit. Total profit rather average book profit is equal to minus 17 plus 50 plus 75 divided by 36,000. less remuneration from alternative employment. Average profits 30,000. Calculation of goodwill charter. Goodwill में average capital employed is how much? 2 lakh. Normal rate of return is how much? 10%. Profit is equal to 2 lakh into 10%. 20,000. Average profit 30,000. Super profits is equal to average profit minus normal profit 10,000. Years of purchase. How many years of purchase? 2 years. So goodwill is equal to 10,000 into 2 years is equal to 20,000 chartered, and we are in the end of question number 2. Correct, chartered? Question number 22. Now, so these were simple questions. Let's move ahead. Let's move ahead, chartered. Question number 22 we have done. So question number 23. Neha and company, the partnership PQ and R. Sharing profit and losses 1064. The balance sheet. PQR reserves, long-term debt, bank overdraft, trade payables, land, building, plant and machinery, investments, inventories, and trade receivables. Okay. It was mutually agreed that Q will retire, and in his place T will be admitted. Okay. For this purpose, the following adjustments are to be made. Building, plant and machinery are to be depreciated by 5%, 20% respectively. Investments to be taken over by retiring partner, that is Q, at 15,000. Provision of 20% is to be made on trade receivables. In the reconstituted form, total capital will be 2 lakhs, which will be contributed by PRT in the ratio 2:1. Surplus funds, if any, will be used for repaying bank only. This adjustment ignore. Because you don't pay bank OD. Suppose you have a bank OD of 50,000 and you deposit 60,000. Obviously, bank OD is repaid. No? So negative balance will by default become positive balance if you keep on depositing money into the bank account. So this happens automatically. You do not do special accounting for it. The amount due to retiring partner shall be transferred to his loan account. Correct? Yes. Shall we start? Yes. Now, Chartered. Solution to question. I solve big questions in a sequential step format. If you like, very good. Otherwise, you can follow whatever you were doing earlier, Chartered. Correct? Step 1. Profit sharing. Profit sharing ratio. A systematic way of presenting the answer instead of doing working notes. Step 1. Profit sharing ratio. Old profit sharing ratio was P is to Q is to R, 10 is to 6 is to 4. New profit sharing ratio P is to R is to T, 2 is to 2 is to 1. Always present all these information. It really makes useful solving also, and it makes it important when the person is checking the answer. Step 2. Valuation of goodwill. In this question, there is goodwill value already given. How much? So this step becomes redundant. Step 3. Treatment of goodwill charter. First, treatment of goodwill has 4 steps. Step 1, new old book value of goodwill should be written off. Is it there? No. Then table entry. Who are the partners? P, Q, R, T. What is the value of goodwill? 1 lakh in the ratio 10 is to 6 is to 4. 50, 30, 20, dash. Correct? Then 10 lakh in new base are 2 is to 1. 40, 40, 20. So his old share was 50, new share is 40, so 10,000 P sacrificed. Q 30,000 says 0, so 30,000. 20,000 R has gained, from 20 it has become 40. And T has gained 20,000. Correct chartered? Yes. Now what shall be the journal entry? Journal entry will be gaining partner. R account debit 20. T account debit 20 to P 10 to Q 30. Correct? Yes. Step 4. Adjustments. Over here we discuss 4 important things. If they are there in the question, I am writing them down. A. Calculation of SOP, that is share of profit, up to date of death or retirement, where you used to pass a journal entry, if you remember, PL suspense to OGP, outgoing partner, either retired or deceased, PL suspense. His share of profit from year starting to the date of death. Yeah. B. Treatment of JLP, if any. C. Assets and liabilities sold or paid. And the last, D, is asset or liability taken over by partners. So if any of these 4 adjustments are there, please chart it without fail. Make sure that you pass a journal entry over here. It will really help you. You will not miss anything in life. Over here, it is very clearly stated that investments are taken over by Q. Investments appearing in the balance sheet is how much? 12. They are taken over at 15. That means investments are increasing by 3. So investments to revaluation. And Q2 investments 15,000, 15,000. So first you revalue and then you transfer. Sir, can we combine the entry? Definitely you can combine the entry, but believe me, ledger posting would be easier if you do pass separate entry. Combine entry I also. Because after looking at the 2 entries, you feel combine entry. Before that, nothing. Correct? Okay. Step. Revaluation account. Building and machinery to be depreciated by 5%. So building is decreasing. SAD. SAD means debit loss. 5% of 2 lakh. 10,000. To plant and machinery has a decreasing loss. 20%, that is 26,000. Investments by revaluation By investments, how much? 3,000. Provision of 20% to PDD, 20% of debtors, 27,800. By loss balancing figure, PQR. 30,400, 18,240, 12,160. Step 6. P Q R T P Q R T. Now, capital account में first you should always post by balance brought down the capital. 80, 20, 30. Then shut your brain and distribute the reserves. It is 20,000 in the ratio 10:6:4, 10,000, 6,000. After this, you religiously follow the steps. Now I will tell you. First step was PSR, no capital account. Second step was valuation, no capital account. Third step was goodwill, gaining partner to sacrificing partner. RT to PQ, RT, P and Q. R and T. Correct? Yes. Then step 4. Q2 investments. Yeah. 15,000. Don't try and do hustle bustle. Step 1, step 2, step 3, goodwill, step 4, adjustment, step 5, revaluation. Loss. $30,400, 18,240, 12,160 over. So step 1, 2, 3, 4, 5 is done. Now there is one thing, capital adjustment. To carry. Total capital should be how much? 2 lakh in 2:1. That is 80 Tata, 80, 40. Yes. Retiring partners capital account will be transferred to loan account. Q's loan account is 22,760. Correct? Yes. And balance will be bank. They will bring money. There is no cash, so I'm writing bank. P will bring 10,400, 78, 160, 60,000, balancing figure, balancing figure. Step 7. Bank account. It's an overdraft, so buy balance brought down 44,000. P got 10,400. Then R got 78, 160. T got 60,000. So our closing balance 104,560. That's a balancing figure. And the capital account. Thereafter charted. Step 8. Balance sheet. First thing you have is P 80, R 80, T 40, Q is loan 22,760. An old balance sheet may have got chartered long-term debt. Long-term debt. How much? 3 lakhs. Bank audit is gone. Trade payables. Land, there is no change. Building has decreased by 10. So 190. Plant and machinery has decreased by 26. So 104. Furniture has remained as it is, so 43. Investments 12. No, investments 0. Why? Because that is taken over. Do we need to write investments? No, we need not write. Inventories 1,30,000. There is no change. Trade receivables 139, less provision for doubtful debts 27,800. That is 1,11,200. And there is a bank balance of 1,04,560. And the total of the balance sheet is 692 760. Correct, Charter. With that, we come to end of the sequence which we follow in the questions. Sometimes you might not like a step, but yeah, it gives you a rhythm. These things, quite a few things, you would have done it in a working note. I have done it in a steps in a systematic order. So all my sums look in a precise form. Now, Chartered, we meet at 155. Fair enough, 155 for the rest of the questions of partnership, Chartered. Now, chartered, let's start with another question with the same steps we'll do. We did question number 23. We'll do now question number 24. Question number 24. Solution. To question 24. Question number 24. A and B are partners sharing profit and losses in the ratio 3:2. First question we did 23. That was admission come retirement. The balance sheet of A and B as on 1/1/18 was as follows: creditors, bills payable, bank overdraft, capital account, building, furniture, stock, debtors, less provision. Provision of 2,000 is already there. Investments and cash, there is no bank overdraft. There is bank overdraft as well as cash. So whenever there is bank overdraft and cash, we'll prefer cash account. C is admitted to the firm. Whenever there is bank overdraft and cash, we'll prepare cash account. He is admitted for 1/6 share and introduces a capital of 25,000. The new profit sharing ratio A is to B is to C is 3:2 is to 1. C is unable to bring his share of goodwill. Partners therefore decide to raise goodwill accounts. Now, partners therefore decide to raise goodwill account in the books of the firm is not valid now. So that point is not required. They further decide to calculate goodwill on the basis of C's a share in the capital contribution made by him to the firm. So whenever it is stated that calculate goodwill on the basis of capital, it means hidden goodwill. Furniture is to be written down by 870, stock to be depreciated by 5%, provision is required. Provision is required for debtors at the rate of 5%. Now chartered 5% of debtors is 35,000. So we require a provision of 1750. And in the balance sheet, can you see I have circled 200 that is already existing. So out of 1750, 200 is existing. So you are supposed to create a provision of only 1550. Provision should be made for outstanding wages 1560. The value of building having appreciated bought up to 29,200. The building balance sheet maintains 26,000 and it should be brought up to 29,200. That means chartered, we are supposed to increase the value of building. Value of investments is increased by 540. It was found that creditors included a sum of ₹400 which is not to be paid off. That means creditors will decrease. Fair enough? Yes. So let's start without any wastage of time. Question 24. Step 1. Profit sharing ratio. Old PSR A is to B 3:2. New profit sharing ratio A is to B is to C 3:2:1. Correct. Step 2. Valuation of goodwill. It's a hidden goodwill. C is a share is equal to 1/6 and brings a capital of how much? 25,000. Therefore, A plus B's share is equal to 5/6 and capital should be 25,000 into 5, that is 1,25,000. C's share is 1/6 25,000. A plus B 5/6 के लिए 5 into 25,000 6 will get cancelled. So A plus B's capital should be 1,25,000. A plus B's capital is 44 in the balance sheet plus 30. 36 in the balance sheet. It is given as how much? 80,000. Therefore, if you compare these two figures, goodwill is 125 minus 80, that is 45. Correct, chartered? Capital should be 125, but capital is only 80. That means 45,000 capital cannot be seen. That is intangible capital, and that is goodwill. Step 3. Treatment of goodwill. A, B, and C. Goodwill is charted 45,000. Old profit sharing ratio 3:2. 27,000. 18,000. 3:2:1. That comes to 22,500. 15,000. 7,500. A has sacrificed 4,500. B has sacrificed 3,000 from 18, it is becoming 15. C from 0, it is becoming 7,500. Therefore, C has gained a charter. Correct? Journal entry. A. Gaining partner C 7,500 to A 4,500 to B, and second is cash to C. C is bringing 25,000 as capital, but is not bringing his share of goodwill of 7,500. So that 7,500 chartered will be deducted from his capital. Step 4, adjustments not applicable. Step 5, revaluation. Now, first thing in revaluation is furniture is to be written down by 870. To furniture 870, then it is stated stock to be depreciated by 5%. Stock is 21,400, 5% is 1070. Provision for doubtful debts we had calculated as 1550, that is 5% of 35,000. 5% of 35,000, that is 1750, out of which 200 is already existing in balance sheet. So remaining is 1550. Correct? That we had already calculated. 5% into 35,000 minus 200 existing in balance sheet. Thereafter chartered outstanding wages, $1,560. Thereafter value of building is increasing by building 3,200, and investment is increasing by 450, and there are creditors whom we are not supposed to pay. Therefore, creditors is decreasing, it is gain. So gain should be credited and loss to be debited. Now chartered, my revaluation account has tallied at 5050, no profit, no loss. So if there was profit or loss, will we adjust to find out goodwill? Yes. If there was profit or loss on revaluation, we would have added or subtracted over here. If there was, added or subtracted in 80,000. If there was any profit or loss, we would have added profit and subtracted loss. If there was reserves also, we would have added. So basically this capital is capital plus revaluation profit or loss plus reserves and surplus. Provided they would have told, we would have added adjusted revaluation and reserves and surplus. Provided they would have told, instead of capital over here, they have told goodwill is calculated on the basis of profit and the capital contribution. Not adjusted capital. Correct, chartered? So if there was revaluation profit or loss, I would have left step 2, step 3, done step 4, step 5, got revaluation profit or loss. I would have left 2, left step 3, done 4, done 5, got revaluation profit. That I would have transferred here. Then would have finished step 2 and step 3. Okay. So if there was revaluation profit or loss, step 2 and step 3 would have left. 4 and 5 we have done. Got the profit. Transferred the profit to step 2. Got the value of goodwill. Then we would have done step 3, treatment of goodwill. Okay, sir. Step 6. Partners. Capital account. Particulars A, B, C. Particulars A, B, C. By balance brought down. Correct? Yes, sir. Then there would have been reserves which is not there in the balance sheet. Step 1 may nothing, step 2 may nothing, step 3 may treatment of goodwill. So I would have written 2 A and B. By C 4,500, 3,000. By cash 25,000. Correct? Yes, sir. Thereafter chartered. Revaluation, step 4 nothing, and step 3 was treatment of goodwill done. Step 4 is adjustment not there. Step 5 revaluation not there. Step 6 would have been to balance carried down 48,500, 39,000 and 17,500. These are balancing figures. Correct? Yes, sir. Thereafter, I would have done step 7. Cash account. To balance brought down how much? 15,500. To C 25,000. By balance carried down 40,500. Correct? Yes. Step 8. Balance sheet. First thing you can see in balance sheet is capital. A 48,500, B 39,000, C 5. Then there is creditor with decreased by 1,400, so 12,900 is appearing in the balance sheet. Decreased by 1,400, so it became 11,500. Bills payable is no changes. Bank OD. Bank OD no changes. Then outstanding wages 1,560. Asset side में building has become 29,200. Then furniture has reduced by 870. So it becomes 4,930. Stock has reduced by 1,070. So it becomes 20,330. That is 21,400 minus 1,070. Thereafter, less provision for doubtful debts. That is 3,3,250. Investments has increased by 450, so it became 2,950. And cash has become 40,500. And the balance sheet total is 1,31,160. 1,31,160. Am I clear, chartered? Yes, sir. So with that, we come to end of question number 24. Now we'll do question number 25. Solution to question 25. On 31st of March 2017, the balance sheet of PQR sharing profit and losses in proportion to their capital. Proportion to their capital chartered. That means profit sharing ratio will become 2:3:2. Stood as below capital. Creditors, land and building, plant and machinery, stock of goods, debtors, cash and bank balance. Sweet. On 1st of April, P decided to retire from the firm. Desired. And the remaining partners decided to carry on the business. It was agreed to revalue assets and liabilities on that date on the following basis. Land and building appreciated, plant and machinery depreciated, stock of goods to be valued at 10,000. Old credit balance Old credit balance of sundry creditors rupees 2,000 to be written back off. That is decrease creditors. Off it is not back. Provision for doubtful debts 5%. Joint life policy surrendered and cash obtained. JLP surrendered and cash obtained 7757. Goodwill of the entire firm is valued at 14,000. P is a share of goodwill to be adjusted in the accounts of Q and R who share future profits equally. Future profits equally, 1:1. The total capital of the firm is to be same as before. Old firm ka capital is how much chartered? Old firm ka capital is how much? 20 plus 30 plus 40, that is rupees 70. So new capital will also be 70. So that would be 70,000 between 70,000 between who retired? P. In between Q and R, that is 35,000 each charter. Am I clear? Yes, no. Amount due to P is to be settled 50% on retirement and balance within 1 year. Balance within 1 year means 50% will become loan charter. 50% will become loan. And the total capital will be 70,000 between Q and R and new profit sharing ratio, that is 1:1, that is 35,000 each. Let's start. Profit sharing ratio. Old PSR. P is to Q is to R. P is to Q is to R. That is 2:3:2. New profit sharing ratio. Q is to R. 1:1. Correct? Step 2. Valuation of goodwill. Goodwill is valued at rupees 14,000. That is given. So in some question that step has calculation, in some question that step does not have calculation. But my rhythm does not break. Step 3. Treatment of goodwill. P, Q, and R. Value of goodwill is how much? 2, 3, 2, 4, 6, 4. Then 14,000 in the ratio 1:1, 7, 7. Now charted, P has sacrificed, so Q has gained 1 from 6 to 7, and R has gained. बल्ले बल्ले gain हो गया. Correct chartered step. What will be the journal entry? Journal entry will be sacrificing. Sorry, gain into sacrificing. Q1, R3, 2P, correct? Yes. Step 4. Not applicable? No. Yeah, there is applicable. Joint life policy is surrendered, so journal entry will become cash account debit to JLP book value, that is nil. So entire amount will be transferred to revaluation. Sir, in this entry, are we supposed to write to JLP nil, or we can write cash to revaluation? You can directly write cash to revaluation. Step 5, revaluation. Land and building to be appreciated by 20%. So by land and building, 20% comes to 6,000. Plant and machine depreciated by 30%. 30% will also come to 6,000, 30% of 20,000. Stock to be valued at 10. Presently stock is 12, so it will decrease by 2. Thereafter, creditors will reduce by how much? 2,000. To provision for doubtful debts. How much? 5%. Debtors is 11,000, so 5% is 550. Joint life policy, तो revaluation में buy cash for JLP. Thereafter, to profit. Balancing figure, which will be distributed between P, QR in the ratio 2:3:2. 3,000, 2,000. Now chartered, step 6. Particulars P, Q, R, P, Q, R. First we write by balance brought down from balance sheet 20,000. Are there any reserves? No. So step 1, nothing. Step 2, nothing. Step 3, treatment of goodwill. QR2P. QR2P. By Q and R. Thereafter, adjustment number 4 will not come. Adjustment number 5, revaluation profit. Two, 3, 2. Now, what is supposed to be paid to P? 26,000. Half is paid. Paid half. That is 13. And loan is remaining half. That is 13. So to cash 13, it is 50% of 20 plus 4 plus 2. And then you write 2 P's loan 13. That you can say is balancing figure also. Then it is stated to balance carried down 35, 35. Capital should be same as before and that too equal. That is 70,000 in 1:1. Balancing figure by cash 3,000. This is balancing figure. So that is your capital account chartered. Step 7. Step 7 is what? Cash and bank account. That is to BD 7. By P we are paying 13. Q is bringing 3. R is bringing 16. So closing balance, and because of JLP also we are getting 550. So by balance carried down comes to 20,500. This is the balancing figure. Yes, sir. Step 8. Balance sheet. Capital P Q 35 R 35 P is loan 13 old balance sheet में creditors 8 asset में land and building has gone up by 6, plant and machine has come down by 6, stock has become 10, debtors 11,000 minus provision for doubtful debts 550, cash bank 20,550. Correct. We are done? Yes, sir. We are done. This is simple. What is the total? 91. 91. Correct, chartered? Yes, sir. Now we are left with, this was question number 25. Solution to question number 26. A, B, and C are partners, sharing profit and losses in the ratio of 8:5:3. Weird. Creditors, general reserves. To long time we have reserves. Partners, loan, capital account, cash, bills receivable, stock, debtors. Okay. From 1st January, they agreed to alter profit sharing ratio. And the new profit sharing ratio they've decided is 5:6:5. Fixed assets valued at 331. Provision 5%. Goodwill of the firm is to be valued at 3 years purchase of average profit of last 5 years before charging insurance premium. That means before considering insurance premium as expense, you are supposed to take profits. And profits they would have considered after expense, after insurance premium. So if you remove insurance premium, profit will go up. There is a joint life policy for rupees 2 lakh which has an annual premium of rupees 10,000. This premium should be added to profit. Why? Because profits would be after premium and we want profit before premium for goodwill. Achha. Charge to profit and loss account, surrender value of the policy. That means they have not surrendered. It is valued at 78. So you will raise the surrender value, write off surrender value. Net profit of last 5 years was 14 plus 17 plus 20 plus 22 plus 27. Goodwill and surrender value of JLP was not to appear in the books. Pass journal entries and prepare capital. So chartered, this question is of change in profit sharing ratio. We did admission, we did retirement, we did admission come retirement, and this is change in profit sharing ratio. Step 1, profit sharing ratio, old PSR, chartered, A, B, and C, eight is to 5:3, new PSR, A is to B is to C, is 5:6:5. Correct? Yes, sir. Step 2. Valuation of goodwill. Average book profit. Average book profit is equal to how much? 14 plus 17 plus 20 plus 22 plus 27 divided by 5. Is equal to chartered how much? 14 plus 17 plus 20 plus 22 plus 27 is equal to 20,000. Correct? Yes. Add back insurance premium because they don't want premium to be debited to profit and loss account. And the question has stated that they have charged premium to profit and loss account. Yes. Question have stated that they have charged premium to profit and loss account. Premium being charged to profit and loss. That means already they have debited premium to profit and loss account. So whatever profit is giving is after charging premium. We want profit before charging premium. Therefore, if we remove premium charted, profit will go up. Therefore, average profit 30,000 years of purchase, 3 years. Therefore, goodwill is equal to 90,000. Oh, very good. Yes. Now, chapter. Step 3. Treatment of goodwill. Correct chapter? Treatment of goodwill. Now, in treatment of goodwill, there are how many partners? A, B, C. Goodwill is how much? 90,000. In which ratio? 8:5:3. 8:5:3 is the value of goodwill charter. So if you distribute that, that will come to 45,000, 28,125, 16,875. Then again you will write off goodwill chartered. 5:6:5. 28,125. 33,750. So A has sacrificed 16,875. B has gained 5,625. C has gained 11,250. So these people have gained. A has sacrificed. The journal entry becomes C. C, B, gaining B, C, 2A. Correct, incorrect, correct charter. This is treatment of goodwill. Done. Thereafter charter. Adjustment for JLP. First is JLP 78, 2A, 2B, 2C, 8:5:3. Correct old profit sharing ratio. That comes to 39,375. And second entry will be A, B, C to JLP. 5:6:5. New TSR, may you write it off. That will come to 375, 29. Acha. Can you see the rhythm? Can you feel the rhythm? Okay, how important the steps become. Step 5. Revaluation. Revaluation. Fixed assets should be valued at 3,31,000 chartered in the balance sheet. It is appearing at 2,80,000. So it will increase by 51,000. Provision 5% to PDD. 5% of debtor 60,000. So provision will become 3,000. Then stock to be valued at 112, stock is 120, the stock will decrease. That's it. So you've got two profits. Balancing figure, which should be distributed between A, B, C in 8:5:3 over BSR. And that would be 12,500 and 7,000. Thereafter, chartered step 6. Partners capital account. Now chartered. In partners capital account, you got particulars A, B, C. A, B, C. So first is by balance brought down from the balance sheet 1,80,000, 70,000 by general reserve. That would be distributed in old profit sharing ratio, that is 8:5:3. So that will be 40, 25, 50. Then there would be treatment of goodwill BC to A. B will be debited 5,625. C will be debited 11,250 by B and C. $16,875. Then there is chartered treatment of JLP by JLP 39,375 to JLP 24,375 29,250, 24, 375. After that, there is revaluation profit. It's 20,000, 12,500. And last but not the least, closing balance 191,500. $71,500. A, B, C. Balancing figures. There is no change in cash bank charter, so directly we prepare step 7. Balance sheet. Capital A, B, C, 191,500, 107. Loan A 40, B 30. Creditors, there is no change. Cash, there is no change. Bills receivable, there is no change. Debtors, there is 60,000. There is a provision for doubtful debts. $57. Stock has reduced my chartered accountants to 1,12,000, and fixed assets have increased to 3,31,000. And there you are with your balance sheet. And the balance sheet shows $5,90,000. Correct charter? No. They've asked us to pass the journal entries. Whenever they ask us to pass journal entries, look at this account and this account only and pass the journal entries. So this will be entry number 1. Revaluation to PDD to stock. Fixed assets to revaluation. Profit on revaluation. Opening balance has no journal entry. Entry number 4, reserves. Entry number 5, treatment of goodwill. Entry number 6, JLP. 7, JLP. Revaluation profit you have already passed. Closing balance can no entry. So look at the revaluation account and capital account. Look at the ledger and pass all the journal entries. Don't think anything more, anything less. All journal entries of revaluation and capital. So first is this 2. Okay. Then this. Okay. Then revaluation profit. Okay. Opening balance no entry. Journal reserve distribution. Then goodwill entry. Okay. Then JLP. Next JLP. Revaluation profit you have passed, you have done. Oh, that's nice. So chartered, we are done with partnership. In the next session, we would do what? In the next session, we would do company accounts, and we would come to end of our revision session organized by education classes. Hope to see you in intermediate. Bye bye. Take care. Bye bye.